Gurur Brahma, Guru Vishnu, Gurur Devo Maheshwaraha, Gurur Sakshat Parabrahma, Tasmai Shri Guruve Namaha. Friends, taxation is the price which civilized communities pay for the opportunity of remaining civilized. A very happy evening to all virtually present here for today's live session on recap discussion on November 2020 RTP, organized by Sikasa Bengaluru. Myself, Shubha Masha, Public Relation Officer of Sikasa Bengaluru. First, I would like to welcome our esteemed chairman of Sikasa Bengaluru, CA Panindra Gupta sir. A very good evening, sir.
Good evening.
Our today's speaker for a live session, sir, is a fellow member of the Institute of Chartered Accountants of India. Sir has qualified BCom CS LLB. He is an alumni of a Jain college in the year 2005 and 6. Sir has having a 10 years of experience in indirect taxes and he is a partner of HSKA and Associates. Sir has presented papers on GST at various forums across India. With this brief introduction, I would like to welcome our today's energetic and dynamic speaker. He is the heart of indirect tax laws. He is none other than CA Hanish sir. Heartily welcome you, sir.
Thanks, Shubham.
Now, I would like to request CA Panindra Gupta sir, Chairman of Sikasa Bengaluru, to address. Over to you,
Yeah,
sir.
yeah. Happy evening and a warm welcome to all the students who are virtually attending today's session on recap discussion on November 2020 RTP on special focus on indirect tax laws. On behalf of Sikasa Bengaluru, I take this opportunity to welcome our today's speaker, CA Hanish sir, the IDT expert. I welcome you, sir.
Thank you.
Thank you so much for accepting our invite, sir. So it's been 3 years GST has been introduced and still the law is evolving every day. And it is a real challenge to keep ourselves updated on this. But our today's speaker is a national level speaker and has presented papers across India since inception of GST law. So I'm sure that he will bring a lot of value addition and explain today's topic in a easier way. And thank you so much. Once again, sir, I welcome on behalf of Bangalore branch and over to you, sir.
Thank you. Thanks a lot, Mr. Panindra, and thanks a lot, Shubham, for this wonderful introduction. And also, thanks a lot for introducing a very unique concept where, through the revision test papers, we will be taking the students through the entire syllabus. We'll try attempting to take them through the entire syllabus. So there are regular classes, there are revision classes, but I think this COVID has made us think in a very innovative way and in different way as to how we can communicate with the students. And this is one very unique experiment which Sikasa is doing, and I'm sure this will be emulated across India. So thanks a lot for this, and I'm very happy to be part of this experiment. Right. So without spending a lot of time on the introductions, let's try straight away get into the presentation mode. Is my presentation visible?
Yes, sir.
Right. Okay. So before we go to the revision test papers, I thought it is very important for us to understand a little background about GST. So we will have a look at that background. But again, I would like you to advise you that last time when I was with Sikasa and Panindra Gupta again had given a very interesting topic to us as to what is the exam pattern for CA final indirect taxes, and you will be able to see that video as well online. So I would suggest that you have a look at that to understand the breakup of marks, because that I'm not going to cover that today, and what are the important areas. You can have a look at that video. I was fortunate enough to be called at that point in time as well. Today we are going to straight away dive into the subject. So we're going to talk about GST, and then we go to customs. GST was introduced on 1st July 2017, so it's just been a little less than 3.5 years since GST has come. So all of us are new to GST. Nobody is an expert in GST because every day we are learning GST. Okay, it subsumes a lot of state and central taxes, and when we say subsume, it means that all those old taxes in the form of excise, VAT, service tax gets deleted from 1st July 2017, that 30th June 2017, and from 1st July, in place of those, GST comes into existence. GST is applicable on a new topic or a new subject called supply. So earlier we would by heart what is manufacture. Every manufacture is a change, but every change is not manufacture. Likewise, now we'll have to by heart what do you mean by a supply. Then it is a destination based consumption tax. Now, what do you mean by a destination based consumption tax? It means the taxes go to the state where the goods are consumed. We'll take an example. If Maharashtra manufactures something and sells it to Gujarat, okay, then as of 30th June 2017, it would be liable to central sales tax, that is CST, and that CST would be retained by Maharashtra because CST would go to the state from where the goods originate, the movement of goods originate. But in GST, this tax moves directly from Maharashtra to Gujarat because consumption of these goods are happening at Gujarat. Okay, and you will find in the GST law nowhere that they have used the word destination based consumption tax. But how do we know that it is a destination based consumption tax? If you look at section 10, 11, 12, and 13 of the IGST Act, you will observe that almost all the provisions say place of supply is place where the recipient is located. So that is what is destination based consumption tax. Okay, now next important aspect of GST is it ensures seamless flow of credit. That means the credit will flow to each and every person who is registered under the GST law and who purchases anything for the purpose of business. So as long as it is not for personal use, anything what he buys will be entitled to claim the credit. Let's take an example in the pre-GST law. If I am a I am a big mall in one of very good locations of Bangalore. Okay, and my output is ready-made garments. So my output is liable to VAT, and my input, that is rentals, is liable to service tax. So my input is service tax, output is VAT. That service tax was a cost for me because I was not able to claim input credit of that. Now, once GST is introduced, there is no service tax, there is no VAT. Input on rentals is GST. Output on ready-made garments is also GST. I will be able to set off the output tax against the input tax, and that is where the government ensures, or the revenue authorities ensure, that I get full credit of all the expenses relating to my business. Okay, the rate of tax, there are multiple rate of taxes here. There is 3% also, there is 5% also, 0.1% also. We are, but mainly majority of the goods are liable to tax under 5, 12, 18, and 28%. Okay, now we would have read in our civics that Indian constitution is federal, but it has features of non-federal, that is unitary nature also. So there are some cases where both center and states decide the law, and there are some cases where center has can overpower the state law. So it has got the features of unitary government also, and it has features of federal constitution being federal in nature also. Now there are few laws which were in the state list where the state had the powers. There are few laws which are in the central list where the center had the power. Now, center was also giving up their powers for introduction of GST, and state was also giving up the powers for the purpose of introduction of GST. Now, what they did is they said, okay, both of us have to decide together if there is any amendment required to be made in the GST Council or in the GST. So that's when a new concept called GST Council was introduced. Now, what is the GST Council? Any change, any notification, any amendment, or any circular to be issued in GST will have to be issued based on the recommendation of the GST Council. So nothing can happen in GST without the recommendation of the GST Council. Now, how is this GST Council functioning, or what are the constitution, or what is the constitution of GST Council? Very simple. All the finance ministers of the state and the finance minister of India, all of them are party to this GST Council. So they are the members of the GST Council. Okay, and any decision is taken based on vote. So any decision to be taken to amend GST or to clarify something in GST requires 3/4 majority. All right, so if more than 75% votes are received in favor of that amendment, then that law is passed or that circular is issued, otherwise it is not issued. Okay, but we also have to understand that center gets taxes from the whole of India, but state gets taxes only what is consumed in their state. So center cannot have an equal vote to what a state receives because center stakes are really very high. So here, very interesting thing, one vote of center has a weight of 33%, 33.33%. That is 1/3 of the GST Council vote goes to the center, and each of the states gets the balance 67%. The interesting point here is that because the majority is required, that is 3/4 majority is required for any passing any resolution. So even if we have a case where center is pushing for an amendment, but all the states are not agreeable to that, that provision will not pass because we cannot reach 75%. Likewise, if all the states want something, but the center says, no, I don't want this, even then the majority will not be achieved because states have only 66%. So a amendment can be achieved or a consensus can be achieved only if center and few states agree to that amendment. Otherwise, that amendment cannot go through. All right. So we've discussed this. Now, there are two concepts here, local supply and interstate supply. When the transaction is a local supply, it will be liable to CGST and the relevant state GST, or if it is a union territory, it will be a union territory GST. Okay, if it is an interstate GST, that is interstate supply, it will be liable to IGST. Very simple. So if I'm selling goods from Bangalore to Bangalore, it will be CGST and Karnataka GST. If it's from Bangalore to Chennai, it will be CGST and Tamil Nadu GST. No, it will be IGST, right? It will not be CGST and Tamil Nadu GST, it will be IGST, right? Okay. Then there are no statutory forms in GST, unlike CST and service tax where we had Form A2, Form C, Form D and all those. There are no statutory forms in GST, okay? Very important, alcohol is not liable to GST. Tobacco is liable to GST also and liable to the pre-GST laws as well. Okay, and petroleum products, 5 petroleum products are completely outside GST. GST Council has got powers, okay, to decide a date when the petroleum products will be included in the GST law, right? And we don't have multiple websites to which we have to log into. If I have to get registered in Karnataka or Tamil Nadu or Maharashtra, Gujarat, Assam, wherever I want to register, I have to log into one portal, www.gst.gov.in. That is the GST portal. Okay, and there are some software providers also which help us in filing the returns. Those are called ASPs and GSPs, right? Now quickly we'll move on to intrastate and interstate supplies. Like I said, section 10 to 13, 10 and 11 goods, 12 and 13 services helps us in identifying whether a transaction can be intrastate supply or an interstate supply. So they say if the location of the supplier and the place of supply is in same state, it will be an intrastate transaction. If the supplier location of the supplier and the place of supply is different, then it will be a IGST transaction. Okay, and that is how we help. It helps us in understanding that consumption decides where the tax is going to be, right? Okay. Now, this credit set off, there could be some problems which can be asked on this. If I have a IGST credit, I have to set it off first against IGST. If I have anything left over, okay, apart from IGST, and I have already paid my IGST liability, then that balance can be set off against CGST and SGST in whatever proportion we want. Okay, so I've seen certain cases, suggestions also, some authors also, where they have first set off the IGST against CGST and then the balance has been set off against SGST. That rule has already been amended. So first IGST against IGST. Once the IGST liability is zero, then whatever balance I have left can be adjusted against CGST or SGST in the way we want to. I would suggest in the examination, excess IGST credit be set off against 50% CGST, 50% SGST. That is a thumb rule you please use. Okay. After the IGST becomes zero, IGST credit becomes zero, I can go to the CGST bucket. So CGST credit first has to be set off against CGST. Anything left over goes to IGST liability. SGST first against SGST, and anything left over will go to IGST. But CGST and SGST cannot be set off against each other, right? Now we go to what do you mean by goods and services very, very quickly. Okay. Definition of goods and services. Goods means anything which is movable but does not include money and securities. So a 100 rupee note or a 500 rupee note or $1 or $10, those are not goods. Security here means shares and debentures. Those are also not goods. Okay. So sale of shares will not be liable to GST, but includes actionable claims. Okay. We'll look at what is actionable claims a little later, and growing crops. Likewise, services has been defined as anything which is not goods. So whatever we are liable to pay tax on is goods and services. So we have to understand if the transaction which we are undertaking is goods or services. If the transaction which we are undertaking is neither goods nor services, I am not required to pay GST. What is goods? Anything movable. What is services? Anything which is not goods is services. Okay, but services also exclude money and securities. That means money and security is neither goods nor services. But a very important thing, Money and securities may not be goods, but usage of money for which consideration is charged, or issuance of security or transfer of security from one person to another for which commission is charged, the usage of money for which consideration is charged, that will be liable to GST. Let's take an example. I go to a bank and I ask him to give me 5 lakh rupee loan. He will give me a 5 lakh rupee loan. That is a transaction in money. He gives me money. I will, at the end of 1 year, 2 years, or 5 years, I will give him back that money. But he charges me a 2% processing fee. That is consideration for use of money. That will be liable to GST. So processing charges is liable to GST. Likewise, interest is a consideration for use of money that is liable to tax, but notification 12 of 2017 gives exemption from payment of tax on interest, and that is why on interest we are not paying tax. If that exemption is withdrawn, then even on interest we will have to pay taxes, right? Then we have something called schedule 3. Now schedule 3 says the transactions which are neither goods nor services. So these are the transactions on which I never pay tax. What are those? Services by an employee to the employer in the course of employment, not liable to GST. But services by an employer to the employee, liable to GST. Gifts by employer to employee more than 50,000 rupees, liable to GST, right? Any court fee or tribunal fee paid, not liable to GST. Functions of a MP, MLA, or any constitution body position, not liable to GST. Funeral, including transportation of the deceased, any services relating to a deceased, not liable to GST. Sale of land or completed building. What do you mean by a completed building? When the occupancy certificate or a completion certificate is issued, or somebody goes and stays in that building, and I sell the building after that, it is not liable to GST because it becomes a immovable property. GST is applicable only on goods, not on immovable property. All right. Now, if you observe, we discussed about actionable claims. So goods includes actionable claims, but Schedule 3 says actionable claims are excluded because Schedule 3 is about anything other than goods, right? So actionable claims are excluded from Schedule 3. So though they are goods but not liable to tax, except betting, gambling, and lottery. So actionable claims in the form of betting, gambling, and lottery only are liable to GST. Any other form of actionable claims is not liable to GST. Okay. Then we have a concept of sale of goods before clearance of customs. CA final, it's very easy for me to explain. If any sale happens before bill of entry for home consumption is filed, those taxes are not liable to GST. Example, high sea sale. Okay. I am getting goods from Africa. I have a customer in Ahmedabad. Even before the goods are reaching India, I transfer those goods to my customer who is in Ahmedabad, and he pays me the customs duty. So that is not liable to GST. But if I sell the goods after that, then it is liable to GST. Example, I am getting goods from Africa. I have a customer in Ahmedabad. I transfer those goods to my customer who is in Ahmedabad, and he pays me the customs duty. So that is not liable to GST. But if I sell the goods after that, then it is liable to GST. Yeah, am I audible now?
Yes, sir. Yes, sir.
Okay, okay.
No.
Sorry, there was a power cut. I'm really sorry for
Yeah,
that.
yeah. No
Okay,
problem.
I'll resume again. Yeah, is my PPT visible?
Yes, sir.
Okay, right. Okay, so for CA finance students, it's really easy for me to say that if the bill of entry for home consumption is not filed and any sale happens before that, then it will not be liable to GST because of Schedule 3. Okay, then we also discussed about alcohol, petrol, and tobacco. That is not liable to GST, except tobacco is liable to GST. But I wanted to bring it as a special point here because all these three are special products. Okay, then we have Schedule 2. Okay, Schedule 2 job is only classification. So it will only help us in classifying whether a specific transaction is goods or services. I've listed down what is goods and what is services as per Schedule 2, right? Okay. Then we go to this most important concept. GST is applicable on supply. So section 7.1 defines the term supply. There are three clauses here, 7.1a, B, and C. Now, what does the 7.1a, B, and C say? Just to summarize, 7.1a is applicable to goods and services. That is, there has to be a supply, there has to be a sale, transfer, barter, exchange, lease, license, rental, or disposal. There has to be a consideration, and that supply has to be in the course of furtherance of business. only then it will be treated as a supply and it will be taxable. 71B says import of services for consideration, whether or not in the course of business, will be liable to GST. So 71B does not require business criteria to be satisfied. Just import of services for consideration is sufficient. C, 71C says if I mention something in Schedule 1, even if there is no consideration attached to it, you are required to pay tax on that. And what does Schedule 1 say? For transactions, permanent transfer or disposal of business asset on which ITC has been claimed. Look at this scenario. I have a laptop, okay, and this laptop is of no use now. So I want to sell it for scrap. I get 5,000 rupees for that. That will be liable to tax under 71A because there is a supply for consideration and this is in the course or furtherance of business. Okay, but this laptop I want to donate to a NGO. If I had taken input tax credit on that when I had purchased it and now I'm donating to the NGO, 71C says it is part of Schedule 1, permanent transfer or disposal of laptop on which you have taken input credit. Even though you are not receiving any money, you are required to pay GST on the same because it is part of 71C. So even if I don't receive any money, I'll still be required to pay taxes on the same, right? That is what is 71C all about, right? Then we have transactions with related persons and distinct person. So even if I don't agree on a consideration, but as long as it's a transaction between related party or distinct persons, I will have to pay tax on that. Related party includes employee and employer. Distinct person includes my own branch outside the state. So if I have a branch in Bangalore and I have a branch in Chennai and I transfer the goods from Bangalore to Chennai, though there is no consideration, though there is no sale, because it is a transaction referred in Schedule 1, I am still required to pay tax on the same. Then third, import of services from related party. Just now we saw import of services for consideration only is liable to tax. But if I have an import of service from a related party, even if there is no consideration, I'm required to pay tax on the same. Fourth, transaction between principal and agent. Now this is really very interesting. Now what GST did is, if I have a distinct person outside the state and I transfer the goods, I'm required to pay tax, right? So what tax planning I can do is, I will not have any branches outside the state. I will appoint a person as an agent. Now I will send the goods to my agent who is not my distinct person, and I am not required to pay tax on the same, right? And agent will sell the goods on my behalf to the to my customer. So here they have distinguished between agent who what do you say, works on his own account, and the agent who does not work on his own account, okay, or who does not work on my behalf. So if he issues invoice in my name and sells the goods, then transaction between me and the agent is not liable to GST. But when the agent issues the invoice in his name, then transaction between the principal and agent is deemed to be a supply under Schedule 1, and that will be liable to GST, right? Okay, then we quickly go on to input tax credit. Now, if it is used or intended to be used for business, I will get credit on input services and capital goods, that is raw materials, input services, and even on capital machinery, right? What are the conditions required to be satisfied? I should be registered on the day when I'm claiming input tax credit. I should have a tax paying document in the form of a invoice or a bill of entry. I should have physically received the goods or received the services. In case of bill to ship to, the day when my customer receives the goods, though the vendor has raised the invoice on me, the day customer receives the goods, it will be deemed that I have received the goods and I will be able to claim the credit. If the goods are coming in lots, then the last lot, that is the last lorry, whenever I receive, I will be able to take the credit. Then another condition is that tax has to be paid by the supplier. Only if the supplier pays the tax, I will get the credit. I have to file the return and I have to mention in my return that I want to claim the credit, right? Next point is, I will avail the credit. If I don't make the payment to my vendor within 180 days, then I have to reverse that credit. And whenever I make the payment to him, I will be able to re-avail that credit. But when I reverse the credit, that reversal has to be along with interest. Okay. Then the credit has to be claimed within 6 months from the end of the financial year. So assuming we are talking about the year 1920, if the invoice is for 1920, the last date for claiming the credit on those invoices is September 30, 2020, for which the return will be filed on October 20th. So the last date for claiming the credit is the date of filing the return for the month of September, that is 20th October 2020, right? And very important, in case of capital goods, I should not have claimed depreciation on the GST portion. If I claim the depreciation on the GST portion and I claim GST also, that means I'm taking double benefit. That is not allowed. So credit gets restricted. Okay. Then credit reversal. When am I supposed to do credit reversal? If I'm using the credits for business purposes as well as some purposes other than business, like I'm a seller of t-shirts. I buy 100 t-shirts, 99 I've used for my own purpose, for sale, and one I've withdrawn from the firm and I'm using it for personal purposes, drawings. Then on that one t-shirt I will not get the credit. Okay. If I'm providing exempt as well as taxable services to the extent of taxable service activity or taxable goods activity, I will get the credit. To the extent of exempt services or goods, I will not get the credit. Okay. Banking and financial institution, they can follow this option of proportionate credit, which we'll look at it a little later, or whatever credit they have, divide by 2. So 50% credit they can take. That is the option there, which has been given to them. Okay. Now, exempt supplies, I've given the definition here. We will solve a problem also on this, right? And then blocked credits, very important. I will never get credit on that. This is given under section 17, subsection 5. Okay. Now, what do you mean by blocked credits? Motor car having a setting capacity less than 13, I will not get the credit. Any expenses relating to that motor car also, I will not get credit. Maintenance, renting, hiring, leasing, insurance, or rent a cab. Anything relating to a motor car which is less than 13, I will not get the credit. Okay, there are few exceptions to that. You will have to look at it in detail. Then health and life insurance of employee, I will not get credit. Works contract for construction of an immovable property, no credit. Food, beverages, outdoor catering, beauty treatment, health and cosmetic surgery, no credit. Travel benefits to employees. If they're going for business purposes, you will get credit. But if they're going for personal purposes and you're reimbursing GST on that, you will not get the credit. Membership of club or health center, any purchases from a composition dealer, goods which are for personal consumption, goods lost, stolen, destroyed, disposed of, or given as samples or gifts, you will not get credit on that, right? So these are the block credits where you will not get the credit at all, right? We quickly go to registration. Now, who is liable to register? Any person having a turnover more than 20 lakhs. That is what is given in section 22. It's undergone a change. We'll look at it in the subsequent slide. Any person who was already registered under the pre-GST law, and in case of sale, transfer, or demerger, the new entity is required to get registered, right? Persons who are not liable to register, section 23. The person who exclusively deals in goods or services which are not liable to GST, or a agriculturist. That means an individual through his own family, if he is tilling the land and producing certain goods, right? That agriculture is not required to get registered under GST, even if his turnover is more than 20 lakhs. All right. Mandatory registration is required if you have interstate supplies of goods other than handicraft goods. If it is interstate supply of services and your turnover is less than 20 lakhs, registration is not required, right? If you are a casual taxable person or a non-resident taxable person. Casual taxable person, example, I am in Bangalore. I want to participate in an exhibition which is being conducted in Delhi. And if I find some customer, I want to sell the goods there. Because I am not registered in Delhi, I will have to take a casual taxable person registration. Likewise, a person in USA wants to participate in the exhibition in Delhi. He will have to take a non-resident taxable person registration. So that's the difference between a CTP and a NRTP, right? OIDAR, online information database access retrieval services. They have to take registration in India. Examples are Amazon Prime, Facebook, LinkedIn, Google Drive. All these are examples of online information database access retrieval services because they are online services who gives us some information, who allows us to access or play some games or watch some videos or download some ebooks and read. So these online services, the service provider, though he is outside India, he will have to get registered in India and pay taxes here. All right. Any person who is required to pay tax under reverse charge mechanism. So if I'm a company who is receiving services from a goods transport agency, then the goods transport agency will charge me for the freight, for the transportation of goods, and I will have to get registered under GST and pay the tax under reverse charge mechanism. If I'm dealing in any notified goods and services, all right, if I'm required to deduct TDS or TCS, TDS comes under 51 and TCS comes under 52. In RTP, there is a specific problem on TCS, so we'll discuss that. Input service distributor, if I want to distribute the credit between my branches, that is called input service distributor, I have to take compulsory registration. And if I'm an e-commerce operator, then I have to take a compulsory registration, right? Then there is distinct person, already discussed in schedule 1. If I have one registration in multiple registrations in different states, or in the same state I can take multiple registrations. So in Karnataka I can take one registration for Koramangala and one for HSR layout. Even then I will be treated as a distinct person. If I have a SEZ unit and other than SEZ unit, which is also called DTA unit, even then I have to mandatorily take another registration, right? Then I can amend my registration if there is some change in the registration details. I can get my registration cancelled on my own if I stop doing business, or if I don't file the returns, or for some reason that I have taken the registration fraudulently. The department can cancel the registration, the officer can cancel the registration. And if I want to give a reply to that saying that what is the reason you have given is incorrect, then I can apply for revocation of that cancellation. So I can apply for registration, I can amend the registration, I can cancel the registration. If department seeks cancellation of registration, I can ask for revocation of that registration, right? Now, like I said, there is some registration limits which have undergone change. If you are in special states like Manipur, Mizoram, Nagaland and Tripura, the threshold limit is 10 lakh rupees. If you have turnover beyond this, you have to get registered. If it is Arunachal Pradesh, Meghalaya, Sikkim, Uttarakhand, Puducherry and Telangana, then the limit is 20 lakh rupees. Meaning all the other states also is 20 lakh rupees only, but only for the purpose of goods a special threshold limit has been introduced, only for goods, and where the taxpayer is selling only goods, not services, only goods intrastate. Okay, and not dealing in notified goods. What are notified goods? Ice cream, pan masala, tobacco and aerated water. This is similar to what is there in the composition scheme. So if he is dealing all these four goods, he does not get an enhanced limit. All right, if he does not deal in all these goods, then the enhanced limit of 40 lakhs is available to him if he is situated in Jammu and Kashmir, Assam, Himachal Pradesh and all the other states which do not form part of this 10 lakh and 20 lakhs limit. So I will repeat again that 40 lakhs limit is applicable only for goods. Sale should be intrastate only, and it should not be relating to notified goods. Only then you will get an enhanced limit of 40 lakhs. That enhanced limit of 40 lakhs, assuming in Karnataka, is not applicable even for services. I'm really sorry, there's a power cut again. I'm really sorry for that.
No, it is
Right.
fine, sir.
Yeah, now is my screen is also visible?
Yeah, yes, sir.
Okay, perfect. Right. Now we go to some statutory updates which have been given in an additional booklet which was published by ICI. All right, we'll quickly go through that. Or we'll do one thing, we'll go to the RTP, we'll finish that, and if time permits, we'll go to these circulars. Right? We'll quickly go through that. All right. Now let's display the first question. All right. So is the first question visible to you?
Yes, sir. You need to little bit zoom.
Yeah, I'll do that. Is it visible? Is it better now?
Yeah, it is better, sir, now.
Okay. So we'll go through this question. Starcart Limited owns and operates a web portal in the name of Starcart, and they're registered with GST authorities in Delhi. It's an e-commerce operator and is liable to deduct TCS under Section 52. Okay, they provide listing services to their dealers, to the vendors. Also, they sell the goods on their own. All right. For the listing services, they charge 10% of the turnover to the seller in the particular month. So whatever the seller sells on their platform, 10% is charged from them. Okay. This listing fee is applicable irrespective of whether the goods are returned or not. So once the goods are sold, 10% is charged even if it comes back. The customer can choose from wide variety of products. The payment is made by the customer through the payment gateway in the online mode only. So there is no cash on delivery. All right. At the time of monthly settlement, Starcart makes the payment to the sellers after adjusting the TCS. So whenever the amount is required to be paid to the vendor or the seller, they will collect the TCS and only then make the payment. Okay, the invoice for goods sold on star card is issued by the seller in the name of the customer, and tax is charged on the basis of the location of the seller and the customer. The goods are shipped directly by the seller to the customer, and there is no responsibility of star card to deliver the goods. In case of returns of goods by the customer, the shipping is arranged by the star card. It charges a fee equivalent to 20% of the value of goods returned as cancellation charges and refunds the balance amount to the customer. Further, 10% of the value of goods returned is collected from the seller as handling charges. So if any goods are returned, the customer has to pay 20% as goods returned or cancellation charges, and the vendor or the seller has to pay 10%. Okay, so when goods are sold, they will get 10%. When the goods are returned, they will get 30%. Right now, we are talking about in the month of January. Okay, in the month of January, Pulkit, a resident of Rajasthan, where was Star Card registered? Star Card was registered in Delhi. We are talking about an interstate transaction, right? Purchased following goods. So in the month of January, Pulkit purchased the following goods from Star Card. He purchased a laptop worth 50,000 and printer worth 10,000 rupees. Now look at this. It is not a mixed supply because it is not a single price which has been paid. And these are not composite supply also, because printer also I can buy individually and laptop also I can buy individually. So these are two separate individual supplies. Both the products are sold by Infocom Limited. So Infocom Limited, who is registered in Uttar Pradesh. The buyer is in Rajasthan and the Infocom is registered in Uttar Pradesh, right? So it will be a IGST transaction again, right? Now, mobile phone having a value of 30,000 is sold by Star Card in their own capacity. That means this is on own stock. CCTV of 1 lakh rupees is sold by Secure World, who is situated in the state of Gujarat. So all the parties are in different states. So all the transactions will be IGST only. All the above transactions are exclusive of GST wherever applicable. There is no input credit. So nobody has input credit. GST is payable in the aforementioned GST is applicable in aforementioned case scenarios at the following rates. So the rate is 18% or 9 plus 9. Basis the aforementioned case scenario, please answer the following questions. Before we answer the questions, let's get into the PPT mode again. Okay, now if you observe here, all the entire concept is on e-commerce. So let's go into the concept of e-commerce. Now, who pays the tax when the transaction is through a e-commerce operator? Generally, when the services or goods are supplied or rendered, the supplier is required to pay the tax. He will collect the money from the recipient and pay taxes to the government. But if it is 9(3), these services, all right, then the recipient pays the tax. This is called reverse charge mechanism. If it is 9(4), where the supplier is unregistered, recipient is required to pay tax. This is amended from 1st April 2019. And in case of real estate, certain services and goods have been notified. Okay, when it comes to 9(5), sorry 9(3) and 9(4), okay, so the second one was 9(3), third one was 9(4). Okay, now there is 9(5), where the supplier renders services to recipient, then e-commerce is required to pay tax, and that is for transportation of passengers by way of radio taxi or accommodation and housekeeping services. In these cases, neither the supplier nor the recipient, the e-commerce operator, is required to pay tax. In our example, you will observe that we are not dealing in notified services. And because we are not dealing in notified services, e-commerce is not required to pay tax. So that means who will pay the tax in our case? Supplier only will pay the tax. Who is the supplier? In case of Starcart selling the goods, Starcart is the supplier. In all the other cases, the seller registered on their platform is the seller, required to pay tax. Also, since we are on the subject of reverse charge mechanism, this you will find it useful, my friends. If you observe, in case of reverse charge mechanism, I listed down all the services which are under reverse charge mechanism. Just observe this receiver category. All right. In case of GTA, it is specified person. In case of government services, it is business entity. And these two new line items, security services, the recipient should be a registered person. In case of renting of motor vehicle, it is not registered person, it is a body corporate. So if you observe, there are different terms which have been used, and that means different implications can come for different categories of services. Example, security services given to a company which is not registered, not liable to pay tax under reverse charge mechanism. But renting of motor vehicle to an unregistered body corporate will still be liable to tax under reverse charge mechanism, right? So that is the importance of the different words which have been used in case of reverse charge mechanism, right? Now we'll go to a e-commerce operator again. Now e-commerce operator can be dealing in goods, like in our case, or he might be dealing in services. Now, in case of goods, he might collect the price, like Flipkart collects the price from us when there is other than cash on delivery. If he collects the money, then actually it should read as TCS. TCS will be applicable, but the tax will be paid by the supplier. But if he does not collect the money, if the e-commerce operator does not collect the money, then there is no TCS liability and the tax will be payable by the supplier. When we are talking about services, these could be notified services, it could be other than notified services. If it is notified services under 9(5), the e-commerce operator will have to pay the taxes. If it is not notified services, again, if price is collected by the e-commerce operator, then the e-commerce operator will deduct TCS and the taxpayer will, supplier will pay the taxes. But if the e-commerce operator is not collecting the price, then the supplier is required to pay the taxes. So this is the sum and substance of all the transactions relating to a e-commerce operator, right? Now, tax collection at source. All right. Now, assuming there is a vendor, there is a seller, okay, there is a customer, and there is an e-commerce operator. Now, how does a transaction takes place? Vendor lists his products on the e-commerce operator. Now, customer looks at the products, he likes one of the product and pays e-commerce 50,000 rupees for the purchase of laptop plus GST. E-commerce operator informs this to the vendor and vendor ships the goods to the customer. Now, once the customer receives the goods, e-commerce operator transfers this 50,000 rupees. But because the money is received by the e-commerce operator, Section 52 mandates the e-commerce operator to retain 1% of 50,000 rupees. 1% of 50,000 rupees as TCS, right? And file the return. Now, e-commerce operator also, because they have given the facility to the vendor to list the products, will charge 10% as listing fee plus GST will be collected from the vendor. So now e-commerce operator in this case will have to collect 1% TCS. The TCS is only on net sales. So that means 50,000 goods sold to a particular vendor from a particular vendor, and for the same vendor there was a 20,000 sales returns. Okay, then the TCS has to be deducted only on 30,000 rupees, not on 50,000 rupees. All right, TCS will be deposited in the cash ledger of the vendor by filing a return called GSTR 8. In the GSTR 8, I will mention the GST number of the vendor. Straight away, that money of 1% which I have collected goes to the vendor account. It is like Form 26AS, right? Okay, and the vendor can now use this cash to make the payment. His liability, whatever he has to pay on that 50,000, he has to pay GST. He will be able to utilize this TCS, which is sitting in his electronic cash ledger, to pay this liability. So that's how that entire TCS works. Okay, so now we'll go back to the question. Now, what does the question ask us to do? If you look at the question here, it says the net basis the aforementioned case scenario, please answer the following questions. The net tax liability, it does not say the net cash liability. It says the net tax liability, including the amount payable as TCS and after set off of credit. So after setting off the credit, what is the balance liability, including TCS, of Star Card for the month of January? That I have to compute. All right. One simple thing what you can do in multiple choice questions is try eliminating the answers. If you observe here, I can never have a CGST, SGST because all parties are in different state. So the answer can now be only A, B, and D. All right. So we'll have to see what is the answer. Let's go to our presentation. If you observe here, there is vendor stock and that is own stock. Laptop is from vendor stock, 50,000. Printer is my vendor stock, 10,000 rupees. Mobile phone is my own stock, 30,000 rupees. CCTV camera is 1 lakh vendor stock. So the total value of goods sold on my platform is 1,60,000 and 30,000. But what is my GST turnover? It is 10% of the listing fee of the turnover of the vendor stock, which is 1,60,000 multiplied by 10%, 16,000, and my own stock is the full turnover, so 30,000. So my GST turnover is 46,000. 18% on that is 8,280 plus on vendor stock, whatever the vendor has sold, and I have collected that money, which is 1,60,000, I will deduct 1% TCS from him and I will pay it to the government. So 1,600 rupees is the TCS liability. So total amount which I am required to pay is 9,880. And if you observe, there is no input credit data of Star Card which has been given. So the input credit is not available. The total tax liability which I will have to pay will be everything in IGST only, nothing in CGST and SGST. Right? So our answer is 9,880. Let's check if we have this answer. Yes, we have this answer. So D is the answer here, right? Now let's go to question number 2. The net tax liability after set off of credit, if any, of Infocom Limited and Secure Limited for the month of January. Now here also, now here everything is IGST, so we will not be able to think too much. I have to find out the net tax liability. So let's go here. Infocom sold laptop and printer 60,000. GST on that is 10,800. Starcard commission on 60,000. They have charged a commission of 6,000 rupees, that is 10%, and they have charged GST on that 1,080 rupees. That is input to me. So net tax liability is 9,720. Likewise, Secure, the output tax is 18,000, but I have an input credit of 1,800. So I will have to pay only net tax liability of 16,200. My dear friends, please observe here, they do not say what is the cash liability, because if they would have said cash liability, Infocom and Secure also get 1% TCS, which can be reduced from 9,720 and 16,200. The balance will be the cash liability. Here they ask about net tax liability, so I've stopped here itself. Now let's check if we've got the same answer. Yes, here we have. So answer to question number 2 is B. All right. Then third, in case it is assumed that Secure World's turnover does not exceed the threshold limit for obtaining registration under the applicable GST law. Okay. Secure World shall charge tax only on the sales made through Starcard. Secure World is not required to obtain registration at threshold limit for obtaining registration is not crossed and no tax is payable. Starcard shall be liable to discharge tax liability of sales made by Secure World. Secure World is required to obtain registration and shall be liable to pay tax on all taxable supplies made through Starcard or on its own. The answer is D, because once you are selling goods on an e-commerce operator's platform where the e-commerce platform is required to deduct TDS, then you are compulsorily required to get registered under section 24, even if your turnover is less than the threshold limit given under section 22. So the answer to question number 3 is D. Okay, then last question, which is very interesting. Assuming that Pulkit, okay, who is Pulkit, who is the end customer, returns the printer. What was the value of the printer? 10,000. Purchased from Infocom in the month of January. So in the month of January itself, he is going to return. So once he returns, Starcart is going to charge 20% cancellation charges and 10% printer handling charges, right, from the seller. The net tax liability, including the amount payable as tax collection at source, and after set off of credits, if any, of Starcard in such scenario for the month of January should be. See, earlier we got the answer as 9,880. And now because there is a sale return, my turnover is increasing by 30% because I'm getting 30% more. So my answer has to be more than 9,880. So logically, even if we don't work out this problem, the answer should be 10,320. It cannot be B because it is C and S. It has to be 10,320 because the liability is only increasing. Let's check if we get that answer, right? So I've discussed this. Okay. Now, if you observe here, earlier my tax liability was 9,880. Now, commission on mobile phone. If the transaction is cancelled, will I refund the commission? The problem specifically said the commission will not be returned or the listing charges will not be returned. So no impact. Cancellation charges to Pulkit 20%, which is 2,000 rupees. Handling charges to vendor 1,000 rupees. Okay. So I should get 10,420. But what am I getting? 10,320. Where did that 100 rupees go? Now, very important, we discussed that TCS is required to be collected on net sales. Now, sales of one of the parties has got reduced by 10,000 rupees. That means the TCS on the 10,000 rupees is not required to be deducted, which is 100 rupees. So my net tax payable will be 10,320 because of reduction in TCS liability by 100 rupees. I hope you are able to follow this, right? Very interesting, and I really like this adjustment. Very interesting adjustment. Okay, now we go to question number 5. Starcard provides a free gift voucher worth rupees 2,000 to Pulkit on 31st January, which can be redeemed against any purchase of goods made in the future. The supply of voucher in the hands of Starcard would become. Okay, now this is the question of time of supply. Let's understand time of supply in case of vouchers. Time of supply is given under section 12 and section 13. Okay. Now section 12 of for goods and section 13 for services says if it is a specific voucher which can be redeemed for specific goods on the date of issue itself, please pay the tax. But if it is a general voucher, then the tax has to be paid at the time of redemption. So take a case of Titan watch. Okay, I get a voucher for Titan watch. It is a specific voucher. It can be redeemed for purchase of Titan watch only, right? It is a specific voucher. On the date of issue, it will be liable to tax. Whereas shopper stop voucher can be redeemed for books, for clothes, for watches, for perfumes, anything. In that case, the day when the customer redeems it, tax will be applicable. So now let's look at this question against any purchase of goods made in the future. All right. So when will it be taxable? Taxable supply of 2000 liable to GST in the month in which the voucher is redeemed by Pulkit. So the answer to question number 5 will be 5B. Right? Okay. Now we'll go to question number 6. Right? Advanced Traders is a partnership firm in Jaipur. Okay, so please note the state. It is in the state of Jaipur. The firm obtained GST registration at their head office. The firm is having its depot for storage of goods in other districts in Rajasthan. The depots are added as additional place of business in the GST registration obtained at HO. Following details are provided about the firm for the month of July. Advanced traders received goods worth 5 lakh for which GST is payable on reverse charge basis. Okay. Now let's look at time of supply in case of reverse charge mechanism. All right. Reverse charge mechanism in case of goods, the time of supply when the recipient is required to pay tax is date of receipt of goods, date of payment, or if the payment is not made within 30 days from the date of invoice, the 31st day, right? That is the time of supply. Now let's go back to the question. The goods are received on 25th of July. All right. So this is one of the event of tax time of supply. The supplier issued an invoice on 24th July and the payment was made on 30th July. So it is date of receipt of goods or date of payment or 30 days from the date of invoice, whichever is earlier. What is earlier here? 25th July, right? So time of supply will be 25th of July. So I will have to pay the tax in the month of July only, right? Even though the transaction is accounted in the month of August, right? In the month of July, advanced traders issued vouchers worth 2 lakh to its customer, which are redeemable against identified goods only. So on the date of issue itself, I have to pay tax. Also, certain set of customers were issued vouchers worth 5 lakh. The said vouchers are redeemable against any supply, general voucher. So I don't have to pay tax now. Only at the time of redemption, I have to pay tax. Mr. X, a partner in the firm, booked a hotel in Udaipur, Rajasthan for wedding of his daughter in the month of October. It is wedding, personal consumption. So I will not get the credit. The advance amount of rupees 5 lakh for booking the hotel was paid by way of online transfer from the current account of advanced traders in July. The hotel charged 28% tax on the amount received as advance and issued a receipt voucher. The advance traders made a supply of goods worth 25 lakhs during the month of July. Out of the supply, goods worth 5 lakh were not liable to GST. So this is exempt turnover. However, advanced traders inadvertently charged GST on such goods and collected the same from the customer. Now this is a case where out of 25 lakhs, 5 lakh, they have collected the tax from the customer, though it is exempt turnover. Now I cannot collect anything as tax and then not remit to the government saying it is exempt. All right. So I will have to pay this tax to the government even though I was not supposed to collect the tax. All right. Now, due to clerical error, advanced traders made a deposit in minor head penalty of major head IGST. So they have paid some amount under IGST penalty of 3 lakh. There is no liability of interest on any IGST liability. The amount is lying as unutilized on the GST portal. Okay, got it. The balance of input tax credit is nil for all registration. GST is applicable at 9% or 18%. Now, based on this, what are we required to do? Compute the IGST liability to be discharged from electronic cash ledger. See, you observe what is the liability to be discharged from electronic cash ledger, ignoring point E, ignoring this penalty paid under wrong head, ignoring this, you tell me what is the tax to be paid. Let's look at what is the tax to be paid. Now, purchase under RCM 5 lakh, we have already discussed, it will be liable to tax under reverse charge mechanism in the month of July itself. Specific voucher 2 lakh, I have to pay it in the current month only. General voucher 5 lakh, I am not required to pay tax in the current month. Taxable goods 20 lakhs, I am required to pay tax. Exempt goods 5 lakh, because I have collected the tax, I am required to pay the tax. All right. So the total turnover on which I am required to pay tax is 32 lakhs. 18% on that is 5 lakh 76,000. And on the RCM which I paid on 5 lakh, I paid 18% is RCM. I will reduce that much amount as my input tax credit. The balance tax to be paid by me is only 4 lakh 86,000 rupees. So the correct answer is D. Right? Amount of input tax credit available to advanced traders against hotel booking expenses shall be. What should be the input tax credit? Now here, if you observe, there are a lot of interesting points here. Point number 1, I cannot take credit on advance payment. Point number 2, for availing the credit, I have to have a tax paying document, not a receipt voucher. I should have an invoice. Third, I cannot take credit on any personal expenses, right? Fourth, hotels outside the state cannot charge me IGST. They have to charge CGST and relevant state GST. CGST and other state GST, that is, if I am in Jaipur and somebody is in Maharashtra, he will charge me CGST and Maharashtra GST. That is not allowed to me as credit. So all these put together, all these reasons put together, or one also, the credit available is nil. So I will not get any credit at all. All right. So answer B and C is wrong. I have to choose between A and D. A says nil. There will be no change even if the hotel is located outside India. Correct. A is the answer. Let's look at D also. Nil IGST of 1,40,000 would be available. No. With IGST, the hotel cannot charge at all. And even if they charge, I will not be able to claim credit because it's a personal expenditure. So answer is A. Answer to question number 7 is 7A. All right. Now, third question. What is the time limit for issuance of show cause notice where GST is collected on supplies which are not liable to GST? Now, show cause notice issued under section 73 and 74, the time limit is the time limit for issuance of order is 3 months. Sorry, for 3 years from the date of the filing, from the due date of filing the annual return. And if it is section 74, that is fraud, then 5 years from the date of the issuance of from the date of the due date of the annual return. Those are the due dates for issuance of order. 3 months and 6 months, if you reduce from there, that is the date within which show cause notice has to minimum be issued. But when you have collected the tax which you were not supposed to collect at all because it was an exempt turnover, there is no time limit for issuance of show cause notice. So here, answer is not A, which is 3 years minus 3 months, or 4 years and 6 months, that is 5 years minus 3 months. The time limit is not there. So the answer is 8C. Okay. Now, advanced traders claim refund of the amount paid erroneously. You remember point E where something was paid as penalty under IGST? The authorities rejected the refund claim. Advanced traders filed a civil suit. Now, you cannot file a civil suit for rejection of refund. You have to file an appeal. All right. So the answer, we choose the correct answer. Magistrate can direct. The jurisdictional magistrate cannot pass any order relating to refund claim. He has to file an appeal within 3 months from the rejection order date under section 107. All right. Last question, I think, in this part. Right. Advanced traders wants to utilize the amount paid erroneously in minor head penalty of the major head IGST against his tax liability to be discharged in cash. This facility is available now. You can file a statement called TMT09 and transfer the credit from one head to another head. All right. So now what is the answer? The amount can be utilized for discharging liability under any minor or major head. So 10, the answer is going to be 10C. Right? Now we go to question number 11. In respect of consignments supplied on 20th August, provisional assessment was resorted to. Now, what do you mean by provisional assessment? Let's spend some time on assessments. We've covered all this. Okay. Now, assessments under GST. There are different kinds of assessment in GST. One is self-assessment. Now, what do you mean by self-assessment? When I pay the taxes on my own and file the returns, that is called self-assessment, section 59. When I don't know what is the value of supply, or I am not able to understand what is the rate of tax, I have to, meaning not because I don't know, but I have to make an application to my officer and say, look, I don't know the value of supply, I don't know the rate of tax. You tell me what is the value of supply and rate of tax. In that case, I will have to tell at what price I will pay the tax as of now, temporarily. Say the value of the goods is 100, but I am not sure about it today. So I will pay tax at the rate of 80 rupees. Okay. And I have to give an undertaking that if the value is more, I will pay the tax on the differential amount along with interest. Okay. I continue paying the taxes on a provisional basis. The order will be issued by the officer confirming what is the value. He can confirm no 80 is correct, or no, actually the value is 60, or he can say 100 is correct, or 120 is the value. Okay. If the liability increases, then I will have to pay the tax on the increased portion plus interest from the original due date, not from the date of the order. And if the liability is less because I paid on 80, but the officer says no, it is 60, the on tax paid on the 20 rupees I will be able to claim refund of that. Plus, if the refund is not given to me within 60 days, then interest on that also at the rate of 6% I can claim. So look at it. If I if there is a additional liability, I have to pay the tax along with interest from the first day, but refund will be at 18%. But in case of refund, I will get interest at 6% after 60 days. All right, so that is provisional assessment. Then section 61 talks about scrutiny assessment. So now they look at form 26as, look at your GST returns. There is a mismatch. They will ask you the question. If you don't reply properly, then they will confirm the demand by verifying the documents available with them. If they do any assessment, that is called scrutiny assessment. Okay. If I am a registered person but I don't file the returns, or if I don't register at all in GST, then the officer can opt for best judgment assessment under 62-63. When they use the word best judgment, it is not for the assessee that is to be a best judgment. For the officer, it is best judgment. For the assessee, it is a worst judgment. Right? Then section 64. If an officer believes that there is some tax payable by a taxable person which he is not paying, okay, and he might evade from the country, then they can go for scrutiny assessment and attach the assets to ensure that the government revenue does not does not remain unrealized. So these are the assessment provisions under GST. The question was on provisional assessment, so we'll go back to the question 11. All right. So here it says provisional assessment was resorted to. The assessment was finalized on 20th of November. So look, I had supplied on 20th of August, and the assessment was finalized on 20th of November. And the taxpayer became liable to pay differential liability of 10,000. So I have to pay differential liability of 10,000. The taxpayer paid the same on 20th of February of next year. What are the number of days for which taxpayer is liable to pay the interest? Now, 20th August supply, he is required to make the payment on 20th of September. If he does not make the payment by 20th of September, he is required to pay interest from 21st September to 20th of February. How many days are there? So I will just make a note of that. On from 21st September, so that means in September 10 days, October 31 days, November 30 days, December 31 days, January 31 days, February 20 days. Totally 153 days he will have to pay the interest. So answer to question number 11 is B. Okay. Which of the following statements is false? This is really very interesting. Okay. Which of the following statements is false? One of the answer we'll have to give. Anti-dumping duty is imposed when any article is exported from any country to India at more than normal value. Okay, that is one. Safeguard duty shall not be applicable on articles imported by a 100% UU resident unless specifically made applicable. Safeguard duty shall not be imposed if the import from that country, which is a developing country, is less than 3% of the total imports of India. Central government may exempt notified quantity of any article when imported from any country into India from the whole or part of safeguard duty. Before we answer this, we should know what are the types of duties in customs law. So let's look at the types of duties. The types of duties which can be charged in customs law are basic customs duty, BCD, social welfare surcharge. BCD is generally 10%. Social welfare surcharge is 10% of 10%, which is 1%. IGST is on value of the goods plus BCD plus social welfare surcharge. On that, whatever is the rate of IGST, 18 or 28 or 5 or 12. Then there are other types of duties. Protective duty. that is levied to protect a particular local industry. All right, like Chen Patna toys, or defense industry, or silk. Safeguard duty. Now, safeguard is, if you observe, protective and safeguard seems to be same, but safeguard duty refers to a duty to safeguard the domestic product from increased import. See, protective duty is not for increased import. Even if there is one import and I want to protect a particular local industry, protective duty can be levied. But safeguard duty can be levied only if there are 5 lakh units, 10 lakh, 50 lakhs, 1 crore units which are being imported into India. Countervailing duty. Now, what is countervailing duty? If, say, from China goods are coming into India, and the Chinese government is saying, if you export the goods to India, I will give you 10 rupees. To countervail the subsidy given by the foreign government, if I charge something, that is called countervailing duty, right? Then anti-dumping duty. If I import the goods at a very, very high volume, all right, same like safeguard, huge volume, and at a price less than the manufacturing price or the sale price. If my normal selling price is 100, I am importing it at 90, or some other country is exporting to India at 80 rupees. That is called anti-dumping. So if you observe, the objectives and the features or the reason for introduction of each of the duties are different. Now, if you observe safeguard duty, it is for increased imports. All right. Now let's look at what anti-dumping duty. Anti-dumping duty is imposed when any value is exported from any country to India at more than its normal value. No, it is less than its normal value. If it is imported at less than its, sorry, exported by that country at less than its normal value, then anti-dumping duty is applicable. So that means 12A is false. All the other things are correct. So 12A is the answer. All right. Now we go to 13, which talks about refund. All right, so let's look at provisions of refund. It is, though it is under the customs law, let's look at the refund provisions. All right, refund under GST. When can we file refund? I can file refund if there is export of goods and I have not charged taxes on those goods or services. Okay, export of goods or services on payment of tax. So I will pay the tax and claim refund of the tax. So for option 1 is I will export without payment and claim refund of input tax credit. Or second, I will export the goods and services and pay tax on the same. Third, deemed exports. If I supply to a EOU, then this is treated as deemed export. I will charge the tax. Then either the supplier can claim refund or the recipient can claim refund. So between us, we can choose who will claim the refund from the government. Both cannot claim, because if I am claiming, I have to take a declaration from him that he is not claiming refund, he is not going to claim input tax credit. If he wants to claim refund, he will have to take a declaration from me that I am not going to claim the refund. All right, inverted duty structure. If the goods which I am selling are liable to tax at the rate of 5%, but the goods what I am buying, raw materials, are liable to tax at the rate of 18%, there is a 13% difference. I can claim refund of that, right? Then I was supposed to pay C and S, but I have paid I, or reverse. That means instead of one tax, I have paid another tax. I can claim refund. Or one of the examples which we saw, I was supposed to pay 1 lakh. By mistake, I paid 10 lakh. Then I can claim refund of 9 lakh rupees. All right. I have paid duty under protest. So I did not agree with the duty, but because interest is applicable, I paid the duty under protest, saying that I don't agree. Then the court gave me a favorable order in my favor. They gave the order. Now I can file a refund claim. All right. That is called duty under protest. Right. I'm protesting to the duty, but still paying it. All right. How do I claim the refund? I have to make an application on the GST portal. All right. Few things which I have to remember when I'm filing refund application is unjust enrichment. Assuming the rate of tax was 12, but I've charged 18, and I've charged that to the customer also. All right. Now I cannot go and claim refund, because then the government will say, or the revenue authorities will say, what did you lose? You were supposed to pay 12, I agree, but you have collected 18 and paid me 18. From your pocket, you have not lost anything. So unjust enrichment, you should not have got that money indirectly from your customer. If you have collected it, you don't please ask me refund. See, deemed export also, if I want to claim refund for the supply made to the SEZ, EOU, then I have to prove that I have not collected that money from him, right? Otherwise, it will be an unjust enrichment. I will not be able to claim refund. Second, a circular has been issued which says you will be entitled to claim the refund of input tax credit only if it appears in your GSTR 2A. What is GSTR 2A? It is a statement which gives me all the transactions where invoices issued to me have been uploaded against my GST number. So if my vendor does not file the return or does mistake in filing the return and the credit does not appear in my 2A, then I will not be able to get the refund of the same. Third, in case of exports and SEZs, if I don't realize the money in convertible foreign exchange, SEZ so anyways only it is only realization. So if I don't realize that money, I will not be able to claim the refund. Okay. Now, in case of inverted duty structure, I cannot claim refund of input services and capital goods. In case of export of goods without payment of tax, I cannot claim refund of capital goods. In case of export on payment of tax, I can claim refund of anything because I'm claiming refund of tax paid, not input credit. Right? Okay. Now let's look at the question here. Now, question number 13 is actually quite weird because it says which of the following is incorrect. So we have to find something which is incorrect. All right. Like here also, which of the following is false. But here they say which of the following is incorrect. So we have to find something which is incorrect in relation to refund. Interest on delayed payment. All right. Interest on delayed payment is payable to the applicant only if duty ordered to be refunded is not refunded within 3 months from the date of application. And here we are talking about customs law, not GST law. GST law, it is 60 days. In customs, it is 3 months. That means it is correct. Okay. If imports were made by an individual for personal use, the amount of duty found refundable is paid to the applicant instead of being credited to the consumer welfare fund. See, in case I'm an individual and I paid extra duty when I'm importing the goods, then there is no unjust enrichment. Correct? So the money has to be paid to me itself. So that means this statement also is correct. That means 3 and 4 should be wrong. If 3 and 4 should be wrong, answer should be C. All right, let's check. Application for refund has been made within 1 year of the payment of duty, where duty is paid under protest. Now, in GST, the time limit for claiming refund is 2 years. In customs, it is 1 year. But duty paid under protest, there is no time limit because it is not a tax paid. It is excess amount paid as deposit. All right. Doctrine of unjust enrichment is applicable if refund of duty is relatable to drawback. Again, it is wrong. Unjust enrichment is not applicable for drawback. Drawback, I cannot pass on that tax to anybody. Drawback itself means whatever taxes I have borne, all right, indirectly, electricity I have consumed. So electricity taxes, whatever I have borne, government is compensating me for that. Correct? So there is no question of I am benefiting from the drawback. And even if I have collected from a customer, there is no link to unjust enrichment and drawback. So that means this statement is also wrong. That means my answer is C and D, which is 3 and 4, which is C here. Okay. Now we go to question number 14. This is a very beautiful and very complicated question. Okay, let's observe let's understand this very carefully. It relates to rule number 43. So of the GST law, of the CGT rules. Okay, KPI Limited registered in the state of Himachal Pradesh and has a manufacturing unit at Baddi, which is also in Himachal Pradesh. Just give me a second. I'll just sip some water. In the meantime, you can have a look at rule 42. Okay, how does rule 42 work? Right. Just have a look at this. All right. So rule 42 talks about input and input services, and 43 talks about capital goods. The question is relevant in the context of rule 43 and not rule 42. But I thought it would be important for us to even discuss rule 42 here, right? So if you look at rule 42, what does it say? If you are in business of providing both taxable and exempt services, how to claim the credit? So it says, go by each of the invoices. If it is for non-business use, disallow completely, T1. If it is for exempt supplies, disallow completely, T2. If it is Section 17(5) credit, block credit T3. What is left over is called C1. Okay, from the C1, which is going to be used only for taxable purposes or for exports or for zero rated supplies, fully you will get the credit. So invoice wise, you are taking the breakup. Ineligible, blocked credit, exempt supplies, non-business use, T1, T2, T3, you will mention. What is used for taxable purposes? T4. Okay. Now what is left over now? From C1, you will remove T4 because that you have taken full credit. What you will be left with is C2. Out of C2, which is common credit, what can you take? See, out of C2 also there might be some cases where some of it is for business, some of it is for not business. You are not able to ascertain. So law assumes 5% is for not for business. So C2 multiplied by 5%, please disallow. All right. Then this C2, which is common, is for both exempt and taxable supplies. So C2 multiplied by exempt turnover divided by total turnover, that much credit also you will not get. So what is disallowed? Not for business, exempt supplies, blocked credit, C2 multiplied by 5%, C2 multiplied by exempt turnover divided by total turnover. What will you get as credit? You will get C2 minus D1 plus D2, correct? Common credit minus 5% of common credit minus 5% of C2 multiplied by E divided by F, that you will get, and you will get T4. So only T4 plus C2 minus D1 minus D2, that is the credit you are going to get. All right. Now we'll go to capital goods example. KPI Limited, registered in the state of Himachal Pradesh. They manufacture XT, which is taxable, ST, which is exempt. Okay. Now they purchased machine 1 in July. All the details relate to July. Machine 1 in July, used for XT and ST, that is common. Machine 2, used only for taxable purposes. Machine 3, used only for exempt purposes. Machine 4 was purchased on October of last year. That means it has already been used for 9 months. For exempt purposes, from 1st July, it will be also used for manufacturing XT. So it will become common from 1st of July. Right? Very interesting. This is a very interesting adjustment. Machine 5 was purchased on 1st January, that is 6 months before, and exclusively used for taxable. From 1st July, it will be used for, it will also be used for ST. That means it will become common, right? Machine 6, purchased on 1st July, 2 years ago, and is being used for XT and ST. All right. So the information given here, I have just, categorized here like this. Machine 1, 2, and 3 are new purchase. Machine 1 is common. Machine 2 is only for taxable. Machine 3 is only for exempt. Machine 4 from exempt to taxable, and full value I have taken as of now. Machine 5, it was earlier taxable, now it is common, so it goes to third bucket. Machine 5, existing machine, and it was common. All right, so this is the information they have given in the problem. Now, what is the information they seek from us? Calculate the amount of ITC credited to the electronic credit ledger for the month of July. Very interesting. What is the credit will get credited to the electronic credit ledger? If you observe here, 72,000 common credit, I will get full. 36,000, I will get full. 1,08,000, I will not get anything at all. 1,44,000, exempt became taxable, I will credit full and reverse 3/4 credit. But as of now, credit to the electronic credit ledger will be full. All right. Then taxable to common, I have already taken the credit. I will reverse it later. But as of now, it is credit is already taken, so it does not get credited to my electronic credit ledger. Existing machine, I have already taken the credit, so I will not take the credit again in July. So the total credit which I am going to take in my electronic credit ledger for this month of July is 2,58,000. That on the top is not quarter 1, it is question 1. In another question, I have used the word Q1 for quarter 1, but here it is question number 1. All right. So the credit which I am going to take in the month of July is 2,58,000 rupees. All right. Then amount of ineligible credit for the month of July. What is the credit ineligible? Now, if you observe, the credit which is ineligible is I will credit full 1,44,000, and because it is used for 3 months, 3 months multiplied by 5% depreciation is what loss is. I will not get the credit. So 3 months multiple 1,44,000 multiplied by 3 quarters, which is 15%. I will not get credit of that, which is 21,600 is a ineligible credit. So I will not get credit of 21,600 rupees, which will have to be reversed in my electronic credit ledger. 1,08,000, the question of reversal does not come because I will not get the credit at all. But 21,600, I will show it as ineligible because I've in the first case taken full credit. So I will take full 144, reverse 21,600, right? Then amount of aggregate value of common credit. What is my common credit? The common credit here is, if we have already identified, 72 plus 1,44 plus 18 plus 1,08,000. Existing machinery also, I will take full value because the reversal is not on 1,08,000. Common credit will be 3,42,000 divided by 60 because I'm going to assume that the credit is going to be used for 60 months. Divided by 60, 5,700 becomes common credit multiplied by exempt turnover divided by total turnover. All right. So the credit commonly available is 3,42,000 and monthly common credit is divided by 60, which is 5,700. To this we will apply the exempt divided by total turnover to find out what is the credit from common I can take. So the credit I can take here is 36,000, correct, plus 3,42,000 minus 21,600 minus 5,700 multiplied by exempt turnover divided by total turnover. That is the credit I'm supposed to reverse. That information is not given in the problem, so we are not going to bother about that. Right? Okay. Next, we'll go to question number 15. Sinotex Private Limited manufactures taxable goods. So taxable goods is Q and exempt good is S. Product X S is sold in the international market without payment of tax. So now what do you mean by zero rated supplies? Zero rated supplies refer to those goods which are exported even if they are exempt. So product S, even though it is exempt, will be treated as a zero rated supply. And when a sale is treated as a zero rated supply, I am not required to reverse the credit. So in this case, even though product S is exempt, I am not supposed to reverse the credit. Very important. Please make a note of that. The company is registered in the state of Maharashtra. Okay. Now the company provides the following details. Product S has been exported at US dollars 12,000. Product Q has been supplied to Betty Enterprises within India at 20 lakhs. So this is export, exempt product export. This is taxable product 20 lakhs. The above amounts are exclusive of GST. The company provides the following information in relation to tax paid on inward supplies. GST of 5 lakh on inputs, GST of 2.4 lakh on capital goods, GST of 2 lakh on input services. All the above are used for manufacturing processes. From the following additional information is available to us. Value of product S exported to UK in Indian rupees is 12 lakh. Similar product, if it had been supplied to a domestic company, I would have sold at only 10 lakh rupees. Betty Enterprises is 100% EOU. It has claimed ITC. So they will claim ITC of whatever I have sold to them. That means I cannot claim refund of the same. The balance of electronic credit ledger for the month for which 3B has been filed is 5,80,000. The balance of credit ledger on the date of filing the refund application is 3 lakh. Compute the amount refundable to Sinotex. So we have to compute what is the refund the company can claim. All right, so let's look at that. Computation of refund. Before that, export. It can be for taxable goods, it can be exempt goods also. Both can be export. And on exempt, I'm not supposed to reverse I'm not required to reverse the input credit. The refund what I will get is list of the following. Credit on input and input services multiplied by export turnover divided by total turnover. Or balance of credit at the end of the month, balance of the credit on the date of filing the refund application. So least of the three I will get. What is the definition of export turnover in case of goods? It is actual export price or 1.5 times the domestic price. Right? A lot of people, what they were doing, they were inflating the export price and claiming more refund because the numerator would be huge. So now they have said, no, you don't do all these things. Export turnover will be least of the following. Whatever you have charged or 1.5 times the domestic turnover. All right. Turnover for services, not relevant for this question, but as a concept. It is on realization basis. It is not on invoice raised. It is on how much money you have received. And also one more important point, there has been an amendment in the GST rules. If I export goods, okay, and I don't realize that money, the sales will be treated as zero dated. I don't have to pay tax. If I export goods, services, and I don't receive the money in convertible foreign exchange, that services which are exported, I will have to pay tax on them, right? If I export goods and I claim refund, or I cannot claim refund on that. See, so if you observe here, goods exported, I don't get the money in convertible foreign exchange. The implication is I will not get refund. But services exported, I don't get the money. I will have to pay tax also, and I will not get refund also. So double impact will be there if I don't receive the money in convertible foreign exchange as far as services are concerned. Now let's look at the problem. The problem says actual export price is 12 lakh, but domestically I would have sold this product at 10 lakh. So 10 lakh multiplied by 1.5%, 15 lakhs. Least of the two will be considered as export turnover, which is 12 lakhs, right? Then what is my total turnover? Export turnover of 12 lakh plus Betty Enterprises. I've sold some goods of 20 lakhs. So total turnover is 20 lakhs. What is the refund? What is the credit available with me? Input 5 lakh, input services 2 lakh, capital goods I cannot claim refund. In inverted duty structure, I cannot claim refund of input services and capital goods. In case of ITC refund, I cannot claim refund of capital goods. So credit what I can take is only 7 lakh rupees. Now how much refund can I claim? Formula. What is the formula? 7 lakh multiplied by 12 lakh divided by 32 lakhs. 2 lakh 62,500, or the month end balance 5 lakh 80,000, or the balance on the date of filing of refund application 3 lakh. Least of the three, 2 lakh 62,500. So I will get refund of 2 lakh 62,500 only. Plus I have supplied the goods to a EOU which is deemed export, but because he is claiming credit, I will not be able to claim refund. So that refund cannot be included in this 2 lakh 62,500 computation, right? Now we'll go to the next question. Question number 16. Examine whether the suppliers are eligible for composition scheme under section 10. Before we get into this question, let's understand what is composition scheme. GST law can be very complex, and the HSN code and the GST rates can be even more complex. So now what government did, they said if your turnover is very low, what is low? 1.5 crores is low, right? Then you can opt for composition scheme where you will have to not bother about HSN code. Whatever is your turnover, you pay 1% if you're a manufacturer or others. If you're a restaurant owner, you have to pay 5% tax. All right. So if your turnover is less than 1.5 crores, you can opt for composition scheme under section 10. All right. What are the conditions? All the branches what you have, everybody's turnover put together should be less than 1.5 crores. You cannot say in Maharashtra I have 50 lakhs, in Bangalore I have got 70 lakhs, in Ahmedabad I have got 1 crore. Individually it is less than 1.5 crores, so I will take composition scheme individually. No, all the units put together it should be less than 1.5 crores. Second, once one unit takes composition scheme, all the units also should be under composition scheme. Third, I cannot come out of composition scheme unless my turnover exceeds 1.5 crores, or whatever conditions I'm required to satisfy, I don't satisfy those conditions. I cannot collect the taxes from the customer. I have to pay it from my pocket. So I cannot say 100 plus 1%. But can I say 101 rupees is the value? Yes, you can. Right? I cannot claim input tax credit. What are the ineligible supplies because of which you may not be eligible for composition scheme? Your service turnover, other than in case of restaurants, cannot be 10% of your last year's turnover or 5 lakh rupees, whichever is higher. All right, we'll discuss that when we are discussing the examples. You cannot deal in supplies which are not liable to tax, like alcohol. You cannot make interstate outward supplies of goods. You cannot supply goods through an e-commerce operator. You cannot be a manufacturer. So this condition is only for manufacturer of notified goods, aerated water, tobacco, pan masala, ice cream. You cannot be a manufacturer of these. All right. Then what is the tax payable? Whatever is your state turnover on that some percentage. Then goods attracting higher or lower rate of tax, don't bother on the full turnover, whether it is 28% goods or 5% goods. You have to pay the tax, right? And even on reverse charge, you have to pay tax at 18%, not on composition rate. What are the rates applicable to you? Manufacturer 1%, others 1%, restaurant owners 5%. Now, there could be a lot of people who are not entitled to this composition scheme because they might have rental income which is more than 10% of their last year turnover. In that case, they have announced a new scheme again. Okay, if your turnover is less than 50 lakhs and you're not eligible for this composition scheme, then you can opt for another composition scheme where the rate of tax is going to be 6%. So what are the conditions? Your turnover should be less than 50 lakhs and you should not be eligible for this composition scheme. Only then you can go for that composition scheme where your service turnover can be more than 10% of your last year's turnover or 5 lakh rupees, whichever is higher, right? And in that case, you will have to pay tax at the rate of 6% of your turnover, right? Next, very important thing, interest received by you is not to be computed or is not to be considered for that 1.5 crore limit. So if your turnover is 1.7 crores and 25 lakhs is interest, remove that for computation of 1.5 crores. All right. Second, for the 10% or 5 lakh service turnover, also interest has to be excluded. So for these two purposes, interest has to be excluded while you're considering whether you are under composition scheme or not. Right. Now let's go to the problem. Now that we have understood the background, let's understand the question. Technology enterprises registered in Jalandhar, Punjab, is engaged in manufacturing. If you are a manufacturer, can you go under composition scheme? Yes. Its aggregate turnover in the preceding financial year is 1.25 crores. They can go under composition scheme. Technology enterprises supplies the computer systems manufactured by it within the state. So they are not making outward interstate supplies. So they are satisfying that condition also. With a view to expand its business, it will also start providing the repair of computer services in the current financial year. They can opt for composition scheme, but they have to ensure that their service turnover is 10% of last year's turnover or 5 lakh, whichever is higher. So they can have maximum turnover of 12.5 lakh rupees, service turnover of 12.5 lakh. Then they are eligible for composition scheme. All right. Second, Mrs. Siddharth and Sons registered in Delhi owns a restaurant. Restaurant, that means you can go under composition scheme. All right, with a turnover of 1.12 crores in the preceding financial year. In view of the growing customer demand, it will also start intrastate trading of beverages. No restriction, you can take the credit unless you are into manufacture of aerated water. Here you are into trading of beverages, so you can opt for composition scheme. All right. Sitaram Associates registered in Sikkim. Sikkim has a 75 lakhs composition scheme limit, not 1.5 crores. It has a turnover of 73 lakhs, so it is eligible. In the preceding financial year, in the current financial year, it decides to shut down the shop chain owing to huge losses. Instead, it will provide intrastate architect services. Intrastate architect services not eligible for composition scheme. In fact, you are not eligible for the 50 lakh scheme also because your turnover is 73 lakhs. Right? Then Deepthi Services Limited, registered in Uttarakhand, is exclusively providing hairstyling services. It has turnover of 34 lakhs in the preceding financial year. 34 lakhs, but hairstyling. So they will not be eligible for the regular composition scheme of 1% and 5%. But because their turnover is less than 50 lakhs, they can opt for 6% composition scheme. Right? Will your answer be different if Deepthi Services also start supplying beauty products? In that 6%, you can have goods also and services also. So no restriction as long as your turnover is less than 50 lakh rupees. Okay. Varun and Arun Associates started a partnership firm in Bhopal, firm of architect. Okay. On 1/4/2020. The firm provides architect services in Madhya Pradesh. It provides the following turnover. It provides the details of the turnover. April to June 20, 30, 20. The firm has obtained the registration under section 22, meaning when they exceed the threshold limit, and pays taxes under composition scheme. Now look at this, they are architect, and if they are under composition, they have to go under 6% only. They cannot go under 1% or 5%. Determine the tax liability. All right. Now, if you observe here, because they have started the business, that means the last year turnover is 0. That means current year they were liable to register. For the first 20 lakhs, they register, no need to pay tax. But once they register, their turnover becomes 50 lakhs, right? And they are required to pay tax on 50 lakhs minus 20 lakhs because on the first 20 lakhs, they were not registered at all. So on this 30 lakhs, they will pay 6%. But after they complete 30 lakhs, their turnover exceeds 50 lakhs. So on the balance 20 lakhs, they will have to pay 18%. So first 20 lakhs, no tax, 30 lakhs, 5% tax, 20 lakhs, 18% tax. Right? Now we go to the next question. Binaka Electronics Limited is engaged in manufacturing television. It is okay. This is a valuation question. So let's look at valuation. Okay. Valuation under GST. How do we value GST? The value for the purpose of computation of GST? Transaction value. What is transaction value? I sold a laptop to somebody at 1 lakh and I sold a similar laptop to somebody else at 80,000. Both the parties are not related to me. First sale, 1 lakh is the tax, 1 lakh is the value on which tax is applicable. Second, the second transaction, 80,000 is the value. So that is called as a transaction value. That can be accepted if the transaction is not between related parties and the price is the sole consideration. So sorry, it says price is not the sole consideration. It should be price is the sole consideration, right? Now it could be monetary or non-monetary, like exchange offers. I gave a laptop at 1 lakh rupees, but that guy said I have an old laptop. So I purchased the old laptop from him and charged him 80,000 rupees. What is the value on which GST is applicable? GST is still applicable on 1 lakh because I have sold a laptop worth 1 lakh by getting 80,000 in cash and 20,000 in kind. Tax is applicable on 1 lakh. Now, what are the additions to be made to the value of goods? Taxes other than GST. If I'm collecting any tax other than GST, I will have to pay taxes on that. Like if I'm collecting rent, commercial rent, and on that I collect property tax from the customer, I will have to pay GST on that property tax also. Liability of the supplier met by the recipient. If supplier was supposed to do something, he was supposed to arrange the freight, but the recipient arranges for the freight. Or supplier was supposed to give cement, but recipient gives the cement to the supplier. That value also has to be added. All right, incidental expenses, freight, insurance, coolie charges, packing charges, all those are incidental to the main supply. It has to be included for the purpose of computation of GST. All right, interest for delayed payment. So I have given you the laptop at 1 lakh, provided you make the payment within 30 days. If you delay it, I will charge you 1% interest per month. That delay in payment also has to be included and tax has to be paid on the same. All right, then subsidy is linked to the price. If the subsidy is given by the central government or the state government, don't add. But if the subsidy is given by anybody other than the state government or the central government, it has to be added. Right? Example, I am selling masks. Okay, face masks I am selling at 10 rupees. Now some NGO wants to promote these masks. So they say you sell at 10 rupees, but I will give you 2 rupees. So now what I do, I reduce my selling price to 8 rupees. From a customer, I'm getting 8 rupees. From this NGO, I'm getting 2 rupees. So total for the sale of mask, I'm getting 10 rupees. GST is required to be paid on 10 rupees because the consideration what I have received from third party as well as from customer put together is 10 rupees. But if I'm setting up a plant and for that NGO is giving 20% of the cost of the setup, now the price is not linked to the subsidy is not linked to the price, but is linked to the project cost. Then that 2 rupees is not required to be added. If it is linked to the price, I have to add it. If it is linked to some other cost, I don't have to add it. Right? Then what can I reduce? Discount on the invoice. I will say laptop 1 lakh. I am very happy with the way you are talking to me. Less 10,000 discount, 90,000 rupees. So discount on the bill can be adjusted. Discount of the bill, meaning you keep purchasing. If you purchase 1 lakh units, buy more, get more discount or quantity or volume discount. At the end of the quarter, I will give you discount on whatever quantity you have purchased. So that is called a quantity discount. How will I issue it? I will give you a credit note. Now, when I give a credit note, the condition here is I will issue the credit note, but if you reverse the credit, I will get deduction from tax. We'll take an example. I sold the laptop at 1 lakh rupees to you, deposited 18,000 to the government. You were able to claim credit of the same, so you claim credit of 18,000. All right. Now, because of something, some discussion between us, 10,000 rupees I gave you a discount. So I issued a credit note too, and 1,800 rupees I adjusted against my subsequent liability because I had paid taxes extra. But what is the credit you have claimed? 18,000. Now government has given you 18,000 credit and is giving me 1,800 rupees deduction against additional liability, which is wrong because government has lost 1,800 rupees. So now to make good that, I will have to pay 18,000. You will get credit of 18,000. When I deduct 1,800 rupees, you will have to reverse that credit. So when you reverse the credit, I will get the tax benefit. How will you get? I get to know whether you have reversed or not is another question. That at the time of assessment we will see. All right. But as of now, one of the condition is that if you don't reverse the credit, I will not get the tax benefit. Clear? Then deposits. In case of rent, the landlord generally asks for a 10 months deposit. All right. The 10 months deposit is not liable to GST because it is not a consideration. But if you give a non-refundable deposit, that means he will never refund you at all. That deposit is liable to tax. Right? Now, when you have price inclusive of GST, some of the problems will say price is inclusive of GST. Then you have to work back the transaction value by using the formula price divided by 1 plus GST rate multiplied by 100. If GST has to be found, price divided by 1 plus rate into the rate, cross multiplication, right? Inclusive method you have to use to find out what is the price, what is the transaction value, what is the GST rate. Okay. Now that we have understood the valuation, now let's look at the question. Pinaka Electronics is engaged in manufacturing televisions. It is registered in the state of Haryana. It has appointed distributors who are supposed to sell the goods at a selling price of 12,000 MRP. The applicable rate of GST on television is 18%. So 18% is already included in 12,000 rupees. BL dispatches the stock of television to its distributor ordered by them on a quarterly basis. In order to promote its sales, the sales head of BL has formulated a sales promotion scheme. Under the scheme, BL offers 10% per television on television supplied to the distributor. It is not if the distributor sells 500 televisions, it is not purchase. See, if you see here, it says if you sell 500 TVs, I will give you 10% discount on the televisions you have sold, not on the TVs which you have purchased. The discount is offered at a price at which the televisions are sold to the distributor. It appoints Shah Electronics, unrelated party, at its distributor in Haryana and dispatches 750. See, the dispatch is more than 500, but he has to sell more than 500 on 8th April as stock for quarter 1. BL has sold the television to distributor at 8,400. Shah requested for a special packing for which 1,200 is being charged. Incidental expenses. Shah Electronics places a purchase order of 1,000 units. So next quarter they have purchased 1,000 units. But the discount is on if the selling is more than 500. Distributor reports 700 televisions sold in April June, so is eligible for 10% discount, and 850 televisions. So in the second quarter is also eligible. The discount policy offered by BL as explained above is also available to Shah Electronics, so it is available. While Shah Electronics reverses the input tax credit availed in July to September, but does not reverse in April to June. That means even if I issue a credit note for 10% discount, GST cannot be reversed. Examine the scenario with reference to section 15 and compute the taxable value. See, in the same RTP, first question was find out the net tax liability. Second was net cash liability. Third now is only taxable value. So you don't have to find out what is the GST. It only says what is the taxable value assuming the GST rate is 18%. They might have given you additional information, but you are required to only restrict the answer to what is the taxable value. All right, so let's look at what is the taxable value. So your transaction value in both the quarters 8,400, packing charges is 1,200, discount in the first case is nil because you're not reversing the credit. In the second case, see, though we are doing per unit computation, okay, but I have to find out the sale value. All right, so we'll come to that. So per unit, I will give a discount of 840 on the selling price. Now, the total selling price per unit is 9,600 and 8,760 for that quarter. Total units sold is 750 and 1,000. So total sales is 750 multiplied by 9,600. 1,000 multiplied by 8,760. 72 lakhs and 87 lakhs 60,000. That is the value on which I am required to pay the taxes. Is this clear? Okay. Now we go to question number 18. Quickly. Subhashni Limited agreed to provide consultancy services to Madhu Enterprises in the month of May, for which it received an advance of 1 lakh on 20th April from Madhu Enterprises. Subsequently, in the month of May, so April it received advances, in the month of May, before supply of services, the said service contract has been cancelled owing to inadvertent circumstances. It has been cancelled. However, Subhashini Limited has issued the invoice for the advance received in April itself and has paid the GST. You are the consultant of Subhashini. Please advise whether it can claim refund of the tax or is required to adjust its tax liability in its return. Okay, so let's look at the option. 1 second, I think uh, one slide is missing here. 1 second. One second, please. All right. So that slide is not there, I think. So now we'll go back to the slide. We'll go back to the RTP only. Here, if you observe, Subhashini has paid the tax on 1 lakh rupees. The option available with her is to issue a credit note because she's already issued an invoice for the advance. Actually, for advance, she should have given a receipt voucher. And then when she gets back the money, when she's paying back the money, refund voucher should have been issued. And the tax paid could have been adjusted against the future liability. But if she has raised the invoice, she has to raise a credit note. But assuming she does not have any transaction in the next month at all, and she wants to claim refund, then refund can also be claimed. So please advise whether she can claim refund. She can. Can it be adjusted against subsequent liability? Yes, she can. So both the options are available with her, right? Narmada Enterprises, a registered person pays CGST, SGST on a transaction considered to be intrastate supply. However, subsequently said transaction is held to be intrastate. Examine the recourse available to Narmada Enterprises. If a wrong tax has been paid, I have to claim refund of that wrong tax and pay the right tax. And very fortunate, the provision says when you are paying the right tax, though you had already paid the wrong tax, you are not required to pay interest for delay in payment of the right tax. So interest is exempt. You have paid the wrong tax, claim refund of that and pay the right tax. That's all. Okay. Now we go to question 19. Rudraksh Manufacturers, Kolkata, is engaged in manufacturing the textiles. It has decided to enhance its production capacity. Therefore, it imports a machine from vessel at 31,650 rupees, inclusive of transport charges from factory of George Inc. up to US port, and 2,500 is handling charges at US port. Okay, so all those are outside India. It has to be excluded and included anyways. Rudraksh Manufacturer provided the following additional information. Charges for design and engineering work undertaken for the machine in USA. Because this design charges are in USA, this has to be included, $1,750. Buying commission paid by Rudraksh. Buying commission is not required to be added. All right. Freight charges from USA to India has to be added. Unloading charges not required to be added. Because unloading and handling charges are not required to be added because these are post input. All right, post the material coming here. Exchange rate to be considered rupees 60 per dollar. The actual insurance charges paid is not ascertainable. You are required to compute the assessable value. You are not required to compute the GST. You are required to compute the assessable value. All right, let's go to valuation. First is exchange rate. What to use? RBI rate, customs rate, or any other rate? I have to always use the customs rate only, CBIC rate, and the rate applicable on the date of filing the bill of entry. That is point number 1. Duty rate, because I can file a bill of entry in advance. And when I filed the bill of entry, the rate of tax was 10%, but when I'm getting the goods in, it is 20%. So the duty rate should be the date of filing the bill of entry or the duty applicable on the date of entry inward, whichever is later. So exchange rate will be bill of entry rate only. Duty rate will be bill of entry date or entry date, whichever rate is applicable, whichever is later, that customs duty rate I have to apply. All right. Now I can have taxable goods also. I can have exempt goods also. On exempt, I am not required to pay customs duty. On taxable, I am required to pay the customs duty. Right? Freight and insurance, very important. If freight, I am able to ascertain, that is the value. In the question, they have already given freight to be $3,000. If they have not given freight, then 20% of FOB value, free on board value. Air freight, even if it is given, it cannot exceed 20%. So if they're given $10,000 and 3,000 is the air freight, it has to be only $2,000. Okay, insurance, if they've given, that is the value. If they've not given, 1.125% of the FOB value has to be considered. Commission or brokerage has to be included, but buying commission should not be included. This adjustment has been asked multiple times, so that is why I have highlighted this adjustment. Okay, considering this, machine value was $31,650. Okay, design and engineering charges $1,750. Right, buying commission nil, FOB value is 33,400. Freight 3,000, which I have to add. Insurance unascertainable. So on the FOB price, that is 33,400, 1.125%. I will get CIF value in dollars. I multiply that with 60 rupees. I'm sorry, I've used the word 70 there. It is actually 60 rupees, will be 22 lakhs. Because exchange rate given in the problem is 60, so I have to use 60 rupees. Yeah, sorry, that is a mistake there. So it is 60 rupees. Right? Now we come to the last question in our RTP. With reference to a drawback on re-export of duty paid imported goods under section 74, answer in brief the following. What is the time limit for re-exportation of goods? 2 years. What is the rate of duty drawback if goods are not used? Up to 98%. If duty drawback allowed on re-export without use, yes, it is allowed. Without use, you can get duty drawback even on wearing apparels, right? So this is as far as what I wanted to discuss with you. Now let's stop the screening for some time, right? Okay. Now we'll see if we have few questions. One question. As you know, our material, there are few updates given at end of each chapter. Those provisions are applicable or not? 100% applicable. Please read those. And also a statutory update material itself has been issued. Please read that material also. Very, very important. Right? So with this, I have finished the entire RTP. And what if you observe, if I've taken if any question is asked, all the associated provisions also I've covered, whether it is relevant for the question or not. I have covered all the associated questions also, like Rule 43 of capital goods. We have also discussed Rule 42 also of input and input services. Refund, whether relevant or not, even input services, capital goods, inverted duty structure, everything has been covered. So with this, what I've done is questions asked in RTP with the associated provisions I have covered. I hope this session was useful for you. I would like to thank Sikasa as well as our members present here, Shubham and Panindra, for inviting me to this very unique program. Thanks a lot. If there are any questions, you can feel free to send an email to me. I'm just dropping my email address here in the chat box. You can send an email to me and I will definitely respond to those. Right. Good.
Wow, what a session it was, sir. So it was a full-fledged session, power pack session. So within 2 hours, you have covered entire RTP as well as the relevant provision and basics of GST. It was indeed a very value addition to all the students, and next 1 month also and next attempt students also will be using this RTP session, and it will be definitely value addition for them. And this shows your clearly planned the entire RTP session, so you have explained it PPT also. Thank you so much for your valuable time, sir.
Thanks a lot.
And Shubham, can you just express your feedback?
Hello, sir. I really enjoyed this session along with the clearing the concept and also, and you have covered very little things very smoothly. But actually, this 2 years session is very small, but you have covered a lot of things in these 2 years, 2 hours. Thank you so much, sir. Thanks a lot for spending a valuable time with us, sir. Thank you so much.
Thank you. Thanks a lot, Parindra. Thank you, Shubham.
Thank you, sir.
Thank you, sir.
Thanks.
Sir, actually, one question like circulars has to be discussed now, sir. Like that, someone is asking.
You
So
want me to discuss the circulars? I have the slides.
Okay.
or
How
can I
much time it will
send the
take, sir?
slides to you? Sorry.
Yeah, yeah. If possible, you can just say, sir. Otherwise, anyways, in the material, if it is there, then they can go through it. No problem.
In the institute material in the statutory updates, those circulars are there. And what I will do is this PPT, I will share it with you so that if anybody requests for the PPT, you can use that. And one more, somebody was asking about the updates. So that updates also has been included in the PPT.
Okay.
Yeah.
Fine, sir. No problem. It will be available in the link provided in this YouTube channel. So PPT will be available by tomorrow. You can students can refer this PPT also.